Now let's bring in Bloomberg best John Herrmann. He is senior fixed income strategist at State Street Global Markets. John is a Bloomberg best on the economy for his accuracy on forecasts, one of the best forecasters in the world. We're glad to have you with us, John. I want to get your take first on the retail sales number that we had today. A big disappointment. We're not getting consumer spending, which is one of the things that you point out we need to have to accelerate the economy, to bump up hiring, to bring in some growth here.
Absolutely. You know, the key going forward is going to be not just sustaining the CapEx spending cycle that we've been seeing, but also to get consumers, keep the consumer in the game and try to start growing these jobs. A possible explanation for the weak retail sales numbers we're seeing today, you know, we can blame it on a couple of factors, but I think, you know, the key thing is that we're not really generating real disposable income outside of transfer payments, and that section of income is still very, very soft. And the consumer in the first quarter, we had a very decent first quarter of consumption, was primarily a good chunk was driven by transfer payments. So what we want to do is we want to get this recovery strong enough so that we can wean the consumer off of the transfer payments and get consumption to grow, we would say, endogenously. That's the real key. But right now, it looks like we're definitely hit a soft patch, and maybe the soft patch bleeds into something worse, like more of a slower trajectory.
Hey, John, you know, one of the things that people are blaming the retail sales number on is the end of a government rebate on energy-saving appliances, and that has affected building materials stores negatively. Isn't it a concern when the public is trying to pass off economic growth to the private, and as soon as a little bit of government stimulus gets pulled out of the picture, all of a sudden they stop spending, even with, we should point out, higher consumer confidence and higher incomes?
Exactly. That's the key point. We see that not just in the building material sales, but we also see it in the home sales. I mean, the home sales numbers that we're going to see over the next 3 months are going to be very weak once that we've had this sunsetting of the tax provisions. So, bottom line is the economy the recovery needs to broaden out. It needs to build more momentum, and it needs to bring more households into the game. But right now, at this point, you have to say in the second quarter that the forces of deleveraging and risk aversion, caution, that kind of thing, you have to say that those forces are winning out.
Let me get, you know, since you're one of the most accurate forecasters in the world, that's why we bring you on. Let me get some forecasts from you. You have been historically, John, very bullish, but it seems that you've been tamed a little bit by this economy. What are you looking at as far as GDP growth? This year, I think you had forecast most recently 3.5%.
Yeah, exactly. I mean, we had to actually throttle back about, you know, in early April, through early April, you know, end of last year through early April, we were thinking that we could probably hit 3.5% this year. We've absolutely throttled back on that. For the second half of the year, we're thinking we're going to be running more like 2 3/4, and there's some chance of downside risk to that. So, you know, we're a little bit concerned now, and it fits in with our bond position and our bond calls. Basically, despite these low yields, we still think the bond sector could actually rally further.
What does that say about jobs growth? I mean, don't we need to get 3% around there or more in order to cut unemployment down?
Absolutely. If we want to be successful in driving the unemployment rate down to 9%, we're going to have to get the economy growing above potential, which is about 3%. We needed to grow, you know, well above potential to start pulling the unemployment rate down, creating jobs, that kind of thing. And right now, it really does not appear to be the case that we're doing that from a spending side. And also, you can see from businesses, from the latest flow of funds data, businesses are extremely cautious. They're hoarding cash on the balance sheet, very cautious in terms of hiring. We're also seeing businesses cautious in inventory stocking. So, you know, we're just seeing a kind of a broad-based, you know, episode of caution. So our view is, you know, yes, we've hit a soft patch in the second quarter, but it could bleed out into something a little bit slower in the second half of the year. And you know, markets really aren't quite positioned for that.
All right, our Bloomberg bull, John Herrmann, growling a little bit there like a bear, coming to us from State Street Global Markets in Boston.